Why is it the stock market is going up despite the fact that there is a well predicted recession allegedly upcoming in the US and maybe world economy?
Today, I interview famed investor Michael Howell, founder of CrossBorder Capital, as he makes the case that a further recession is not happening. In fact, we're at the beginnings based on the data of a new bull market. Michael shares his knowledge on macro, Fed interest rates, Bitcoin, investing advice for new investors. But before all that, Michael, what's your background?
Well, yeah, goes back quite a while. I originally was in academia. I kind of got, I suppose, disillusioned with that. I was doing a master's and PhD in economics, finance, etc. So I moved into industry, and I was working in corporate planning for a UK industrial company for 2 or 3 years, and then basically the financial sector began to explode in a favorable way. This was so-called Big Bang, as people may remember it in the mid 1980s. There was a huge influx of capital into London. American banks came in sort of big time. I joined Salomon Brothers, and I was research director there. And basically, I spent about 7 or 8 years with Salomon Brothers, and then moved on to another investment bank called Barings, who I'm sure people would have heard of. And after working for maybe two volatile investment banks, I thought it was time to set up an investment advisory company. So I did that independently in the late 1990s. And I've been doing that for the last 25 years or so.
And one of your main core competencies is macro and liquidity. Could you go into why that's important?
Correct. Yeah. I mean, that's very much coming out of the Salomon Brothers school. For those that don't know or don't know financial history, Salomon Brothers was the biggest fixed income trader worldwide. It was the global bond markets. It had big footprint in global forex markets as well. And basically, the theme behind Salomon Brothers research and its proprietary trading was understanding flows, understanding the flow of capital around the world. And the doyen of flow of funds analysis is a gentleman called Henry Kaufman, who's now in his 90s. Henry was head of research at Salomon Brothers and did a lot of the pioneering work on understanding what are called the Z1 accounts, which come out of the Federal Reserve.
So what happened in markets this first half of 2023? Because one of the main reasons that you got put on my radar is you were on podcasts back in January of 2023 when maybe market sentiment was at its worst. And you were saying, hey, I think there's maybe a bullish uptrend in liquidity here. So what happened?
Yeah, well, that's exactly what happened. I mean, basically, what you saw were a number of features going on, but I'll drill down and focus on two of those. One was that you saw in the end of the fall, around let's say end of September of 22, there was something called the British gilt crisis. That was for the maybe an esoteric concept, but basically it occurred because the incoming new prime minister in Britain, and her chancellor decided on a very, let's say, pro-growth budget, which involved a lot of, let's say, fiscal risks. So it was an unfunded program. The financial markets got spooked by that. The British gilt market, the bond market, the sovereign bond market sold off heavily. Yields spiked. And that was a wake-up call for governments worldwide, treasury departments around the world, because had that same phenomena occurred in the US treasury market, there would have been another 2008 global financial crisis. Such was the extent. I mean, it was a big spike in yields, and markets wouldn't have taken that. And that was the time where Janet Yellen began to voice concerns about illiquidity in the US treasury market. If people recall, and what you began to see around that time was what we labeled as stealth QE, which was probably a joint operation between the Treasury and the Federal Reserve to try and stabilize US bank reserves. Under the quantitative tightening label, as the Federal Reserve withdrew liquidity from US markets through most of last year, US bank reserves held at the Fed began to diminish quite significantly. That was a big liquidity squeeze. But following the end of September and the debacle in the British gilt market, US bank reserves then flatlined, and they were held at about $3 trillion US dollars as a level. The next iteration was the SVB banking crisis, the Credit Suisse, etc. debacle around March of this year. That led to a further increment of liquidity by the Federal Reserve. There was direct support through the discount window, in other words, lending to banks and further support. And you saw various other measures, such as a rundown of the Treasury General account for various reasons approaching the debt ceiling. Bottom line was liquidity started to pick up. So that's point number one. There was what we might call a stealth QE, because the authorities were denying that that was happening, and they kept on insisting that they were operating a quantitative tightening program in the background. That clearly wasn't true. Markets respond to liquidity, and the most sensitive asset classes to liquidity are things like cryptocurrencies and the NASDAQ index, and both of those have been flying pretty much ever since. The other big change was the end of lockdown in China, where you saw from the Chinese economy an attempt to, or Chinese policymakers, an attempt to goose the economy with a lot of monetary stimulus. China enacted that through December, January of this year. There's subsequently been a bit of a lull in that. So of the last 3 months, in fact, in April and May, out of those last 3 months, April and May have been negative months in Chinese liquidity, but June has been a very big month where the Chinese have added another trillion yuan of liquidity to their money markets. They're trying to get the economy revved up again. So the bottom line is that don't listen to what central bankers say, watch their hands. And that's really what we've always done through, certainly, my career, is looking at central bank actions. And this has really been key to understanding the markets. Money moves markets, and that's the bottom line. That's what you've got to try and understand.
And just to be ultra clear, because I totally understand that the Fed was then lending to banks like SVB. I saw that. What is stealth liquidity, and how is it different than just full-on quantitative easing?
Well, it's this is where it gets somewhat wonkish, because you've got to start to look at a lot of the line items in the Fed balance sheet. But the key thing to say is that not all elements on the balance sheet are necessarily liquidity creating. So there's been a huge focus on the overall balance sheet size, which, in truth has been shrinking. But there are various elements within that mix of items on the balance sheet that don't create liquidity. They may even withdraw liquidity. One of the key ones has been something called the reverse repo program. Now, the reverse repo program can be thought of as the Federal Reserve basically issuing very short-term securities and mopping up liquidity from the markets. And that reverse repo program swelled to huge size. It was basically at its peak around $2.5 trillion US dollars. It's currently on the way down. It is being tapped by bill issuance from the Treasury as we speak. And it's currently, latest daily print has been under 2 trillion. So you've lost about $0.5 trillion in that reverse repo program. That is a withdrawal of liquidity from the markets. But as that program shrinks, money is added back into financial markets. So these are sort of fairly wonkish considerations. But the fact is that what you've got to look at is an aggregate that we calculate. And if anyone's interested, look on Twitter, because we frequently give definitions of what we do. And that basically shows how to calculate that if you want to do that. That is one of the elements that's very important. Fed liquidity has been rising for a number of months now, but it's something that one's got to look at. Now, I can detail why liquidity is important. I can put up a chart, if you like, which gives some of the sort of illustrative backdrop. Here you go. So what this index here is looking at is a proprietary index that we calculate. This is made available to our clients. We provide data extensively for not just the world economy or the US, but basically 90 economies worldwide, if that's what you so want. We provide a lot of that data to quant funds around the world. This is showing the global liquidity index. This is an aggregate. It's basically a weighted index, makes it easier to understand if we put it in index form. The way to read that chart is to say that if you're at the bottom of that at that chart where the index is close to zero or thereabouts, very close to zero in that gray area, that's when liquidity is tight. And that's when you normally get, as the label says, banking crises. And you can see we've helpfully labeled a lot of those crises, of which the latest iteration, US regional banks, Credit Suisse, First Boston, as examples. But there have been lots of others through time. The Scandinavian banking crisis back in the early 1990s, Bear Stearns, Eurozone banking crisis, etc. This chart begins here in 1990. We've got a much bigger one that goes right back into the 1960s, same point. At the top of the chart, what you can see there are what we label asset booms. That's when there's lots of liquidity in markets, and that's basically when you start to see evidence of strong gains in asset markets. Asset markets respond to liquidity. They're one of the first things to do that. And maybe what I should say, just to clarify, what we're looking at here is money that is moving around global financial markets. It's the credit and the savings flows that are going through world financial markets. It is not money that is in the real economy. It is not really related to conventional monetary concepts like M1 or M2 that people will be familiar with. Those are much more measures of money in retail bank accounts, and those retail bank accounts are much more synonymous with movements of real economy money. We're looking here at financial sector money, which is really driving the asset markets worldwide. Now, it tends to lead real economy money. That's one of the things to note. So if you're seeing an inflection now upwards in the liquidity cycle, that's important because it suggests that maybe better times are ahead. And if you look at this following chart, what it shows is the global liquidity index again, which is all 90 countries, all forms of liquidity. And what we put on top of that is something that we call the US dollar monetary base. Now, the US dollar monetary base again needs a bit of definition, but basically it is the effective part of the Federal Reserve's balance sheet. In other words, how much liquidity they put into US domestic markets, plus the spillover of dollars that end up in foreign exchange reserve accounts of foreign central banks. So it gives you an idea of the amount of dollar availability worldwide, given the fact the dollar is the key currency worldwide and effectively is the international standard of value. That has a big role in driving global liquidity, or certainly has done for the last 10, 15 years, closely as the chart indicates. And that rise in the black line, which you show as the growth rate as an annualized 6 months change in the US dollar monetary base, should be a leading indicator of better times in terms of global liquidity. Now, we can go on from that and say, well, okay, do we have further evidence? What is this likely to say about the upcoming landscape? And I can maybe just show you two other charts which illustrate that. One of those is to look at what's happening in terms of the funding of the US government right now, and maybe to draw some parallels of what's happened in the past. Now, one of the things that the US Treasury is slated to do, and this is why it's probably not just correct to say that there is ongoing a stealth QE, or what we've also called a not QE, because the authorities are in denial of that. But there's also something else which is a bit more subtle, which you may use the acronym for yield curve control, YCC, and say there's a not YCC going on. In other words, there's a subtle yield curve control being operated by the authorities. And what I mean by that is they're trying to control the US Treasury market for the better, perhaps, but they want to try and keep a cap on yields and improve liquidity in the Treasury market. Now, that's a kind of long-winded way of saying that what they're doing is they're changing the pattern of issuance of debt in the US. And what this chart is showing is the projected growth in Treasury bills. So that's debt instruments up to 1 year in maturity that is being issued newly by the US Treasury. Now, as you can see by the dotted line, this is their prospective issuance, is what they claim they want to do over the next 9 months. And the growth rate of Treasury bills in issue is slated to grow at over 30%. Now, historically, that's normally been quite a good heads up to an increase in global liquidity. So what you've got is a backdrop which is really saying, number one, we're seeing evidence that the Federal Reserve itself is starting to project more liquidity or inject more liquidity in the system. Dollars are beginning to spill out into the world economy. Foreign central banks are accumulating those, and they can monetize those effects. So in other words, this is a big restart of the monetary cycle. But on top of that, you're seeing the US Treasury, through its policies of trying to increase bill issuance, actually also helping the whole process. Now, part of what the Treasury is doing is trying to get something I spoke of earlier on, the reverse repo program, down in size. And that is directly, or would directly be, a source of liquidity inflow. And they're doing that by targeting the money market funds directly with bill issuance. So they're marketing bills unusually in a direct way to the money market funds to try and, as I say, get that reverse repo down. They're also, as far as I can see, trying to reduce volatility in the Treasury market. And if they manage to reduce volatility in the Treasury market by the careful management of debt issuance, then what you're likely to see is general liquidity boosts in the system, because what we live in today is a financial system that's more and more rests on collateral, and that collateral is largely dominated by US Treasury notes and bonds. And if there's high volatility in the bond markets, it makes it far less attractive for lenders to lend against collateral. So the so-called haircuts that are applied to collateral tend to increase during periods of high volatility, and that crimps liquidity creation. So all these moves are trying to get liquidity up, and that's the way that we envision things. So basically what you've got is an environment where, whereas in 2022 there were headwinds facing investors, we think there's now a tailwind behind investors. And what's more, that tailwind may well last until 2025, 2026. Now, it won't be a straight line, but things are improving. And just before I pass it over again, the other chart that we ought to be thinking about is this one. And this is the same illustration of US dollar monetary base, which is the black line, showing that the cycle is restarting. I've advanced that in time, so pushed it forward almost a year, so it's predictive. And what I've put on top of that is the average outlook, business outlook, from two key surveys in the US, the New York Fed Empire State Survey and the Philadelphia Fed Economic Survey. Now, I would suggest that that's not a bad relationship. What it's suggesting is we may be seeing an early bottoming out in the economy, and that is something that perhaps the stock markets are already beginning to move towards. The stock market always looks forward, of course. It discounts about 6 months ahead, and if this prognosis is correct, the move up in financial markets and stock markets around the beginning of this year would be pretty much on track for some bottoming out in the US economy around about mid to late summer of this year. So that's what our data is showing. It's certainly non-consensual. It's sort of left field, but it's maybe a controversial point to debate.
So just to be clear, you're based on liquidity, you're bullish for the next year plus, maybe till 2025, but
correct.
There could be.
I mean, we've got to accept the market's never move in straight lines. There'll be periods of profit taking. There'll be doubts, but broadly, that's what's going on. And, if we come down to why, I mean, this is a question that our clients keep asking me. Why is it that you get a situation that the stock market is going up, despite the fact that there is a well-predicted recession allegedly upcoming in the US and maybe world economies? Because we know that stock markets earnings are very sensitive to periods of recession. And if you get, if earnings get creamed in a recession, why should stocks go up? Now, my answer to that is twofold. One is that if you look at this chart in front of you, you'll see that the orange line has already cratered significantly. So we've already had a very significant slowdown in the tempo of business activity. So in other words, how much lower can it really go is point number one. And the second point is that the stock market doesn't only care about earnings. The other big factor which drives stock markets is actually what is in the textbooks called the discount factor. In other words, the PE multiple. And PE multiples are very sensitive to the inflation backdrop. Now, the inflation backdrop is coming down fast. And if I can just slip on another slide, this is a chart which shows what we call the inflation pass-through parameter for the US economy. Now, why is this so important? It's so important because stock markets are priced relative to inflation. And inflation is the key metric in terms of determining the PE. I'll prove that point in a second, but just bear with me in terms of what's going on here. What this is showing is the, if you like, the echo effect or the persistence of inflation in the pricing structure in the US economy. Now, it's measured in months, and what it's really saying is that if you get an inflation shock in June, how many months will that inflation shock typically last through the pricing structure? The longer it lasts, the more embedded inflation is, and the shorter the window of persistence, the less the inflation pressures in the economy. Now, what you can see is that we've estimated this pass-through parameter going right back to the 1950s. This is an alternative measure of inflation. It's one I prefer because it's basically telling you a lot about inflation expectations, which is what the Federal Reserve and other central banks think is key to the inflation outlook. At the time of Volcker's entry into the Federal Reserve in 1970, late 78, early 79, what you saw was a peak in that pass-through data of about 55 months. Now, that was saying that an inflation shock in the end of the 1970s took almost 5 years to pass through the economy. So you could see that there was a big inflation problem. Volcker nailed that. It took him several years to do that, but you can see that the pass-through data comes right down. What we saw in the latest inflation spike was a pickup in the pass-through data to almost 32 months, and that occurred in the middle of 2021. What's happened since then is the pass-through has come crashing down. It's currently 11 months. That's still too high probably, but it's on its way down. And the point that we'd make is that this is actually evidencing a much faster arresting of the inflation problem than Volcker got back in the early 80s. In other words, the inflation is being washed out of the system very, very fast. It's not to say it won't reappear again. I'm not saying that, but I'm saying for the moment that inflation is coming down. Now, why is inflation so important for the stock market? Let me just address that question, and I may have to flip forward a few slides.
Let's do it. I'm
so
loving
just
it.
Bear with me. And let me show you this chart. Now, this chart is looking at a trade-off between equity holdings, which is the data on the left-hand slide. You'll have to accept my word for that, looking at where it says ratio of P to L. That's the value of all equities against the pool of liquidity. And that is showing that against the average inflation rate over a 5-year period. Now, what it says is that if you look at that left-hand ratio, that's saying how much equity is held per dollar of liquid assets. And what it says is that at around 6% inflation, core inflation, investors hold 40 cents in equities for every $1 of financial liquidity. If you move up to 2% in underlying inflation, that 40 cents doubles or maybe even triples, nearly triples, goes 2.5 times perhaps, to about $1 for every $1 of liquid assets. So you can see that inflation is very important. Now, this is an unfamiliar way of looking at this, so I'm going to jump to a very familiar way, which is looking at PE multiples. And this is why this is so critical to understand, particularly for those that are very nervous about upcoming recession. The right-hand chart is taking data from Robert Shiller's website, and those of you familiar with Robert Shiller, the Yale professor, this is academic research, but it basically shows something called the CAPE, which is the cyclically adjusted price earnings multiple on Wall Street. And that is the orange line. And I've charted that back to 1890. So there's a heap of data in there. The dotted line is the average 5-year inflation rate for the US economy, charted contemporaneously. That to me suggests that what is the key metric for understanding the level of the price earnings multiple on the US market? It's inflation. If inflation, and by the way, the inflation data is inverted if you look at that right-hand scale. So the scale gets bigger as you go down. So if inflation picks up, that dotted line goes lower. And if inflation is low, the dotted line is high. And that corresponds to a high PE. The way that most analysts and most investors value the stock market is against fixed income. And that is the wrong way to do it. And what I've shown for comparison on the left-hand slide is the 5-year CAPE, the cyclically adjusted PE for the US market, and the long-term bond yield, again taken from Robert Shiller's website. There was a very small period that one could argue from the 70s through until the early 2000s, where the bond market was an extremely good metric for the stock market. But since then, it hasn't worked particularly well. And a lot of people that use the so-called Fed model, which is a valuation model that uses inputs such as long-term bond yields to value the stock market, value Wall Street, have been going seriously, derailed over the last few years by looking at that metric. Essentially, what you've got to do is look at inflation, and inflation is coming down until it's not. But for now, it's coming down. Therefore, what I would argue is that the two factors that are driving the market at the moment, liquidity is rising, courtesy of the Federal Reserve, courtesy of the Treasury, and courtesy of the People's Bank of China. And the other thing is inflation is coming down because we've won what may be a temporary, but it's still a meaningful victory over inflation pressures.
When do you think the Fed is going to cut rates, or does it not matter based on this?
Well, I think that's a complicated question. I think the answer is that if you're talking about policy rates, I don't think policy rates get cut that quickly. In my view, they're going to remain elevated for some time because actually we got into this mess through very low or zero interest rates. And the issue that we faced, and if you look back at Fed policy in the last decade or so, and particularly the post-GFC policy response, the Federal Reserve enacted what everyone knows as QE. QE was a policy that was not trying to revive the economy, it was trying to create financial stability. And effectively, the financial system was very rocky, it was fragile, and the reason it's fragile is because of the huge debt load that the economy has taken on. Now, one of the points that I make, which is somewhat contrary to, let's say, the textbook view, is that the textbooks see financial markets as capital raising mechanisms. In other words, what they argue is that that Wall Street or the bond market is really there to raise new capital for capital investment programs, and that is the source of future economic growth. Well, nice idea, but we're a long way away from that world now. In actual fact, the financial markets are there for refinancing existing debt. And something like out of every $8 that is transacted in global financial markets, $7 out of that 8 are basically refinancing transactions. In other words, rolling over debt. Let me illustrate. You've got $350 trillion of debt worldwide in the world economy. And that debt has an average maturity of about 5 years. So simple math says that you've got to roll over $70 trillion of debt every year just to stand still, okay? And that debt needs balance sheet capacity, in other words, liquidity, to do that. And therefore, this is why debt refinancing, debt rollovers dominate the financial markets. If you don't have that liquidity in place, you won't be able to roll over debt, and effectively you've got a financial crisis. And I'm not saying interest rates are unimportant, but they're not really the main consideration. And think of that from a homeowner's perspective. If you've got a 20-year mortgage, you come up for the renewal of the mortgage, you've got to roll it, and you can't find anyone to roll it, you're homeless. Doesn't necessarily matter about what interest rate you pay. I mean, obviously it's a consideration, but you want the roll on that mortgage. And similarly for a corporation, if you can't roll your debt, you're insolvent. So the roll is critical when you've got a world of dominant debt. Now, how did we get into the mess of $350 trillion of debt? It was largely because the reckless central banks crushed interest rates to zero or near zero in the period in the early 2000s. And that was a mistaken policy, and it incentivized a debt take-up. And if you want the reason why they went down that road, it's very simple that it comes back to a 5-letter word that's dominating the world and financial markets called China. What happened was that China entered the World Trade Organization, was allowed in to compete unfairly with the rest of the world in 2001. And what China did was to create almost instantly a cost deflation, because China set its exchange rate way too low. And as we know, Chinese wages are significantly lower than the rest of the world. That was a big cost deflation. The central banks got spooked by that because they misread that cost deflation for a monetary deflation. And they knew from the lessons of the history books back in the 1930s that monetary deflation is a bad thing. And so they scrambled to try and avoid the monetary deflation, and they slashed interest rates. And that was not what they should have done. It wasn't a monetary deflation, it was a cost deflation. Basically, the private sector should have adjusted to that itself, but too much intervention by the state basically caused a problem. And that basically meant that what you got was near zero interest rates. It caused this big incentivization of debt, and it created huge fragility in the global or the Western financial systems. And that's where we are now. The problem is, looking forward, we've got a situation where we're moving into a world where the paramount problem is not necessarily just financial stability, it's fiscal stability. And what I want to do is maybe just focus on what that problem is, because it's a big one. And I'm going to go on to a later chart which illustrates what the problem is. Now, what this chart here is illustrating is the holdings of US treasuries by the Federal Reserve. And that is the data that we see, first of all, as the orange bars. The scale on the left-hand side is in billions of dollars. So you can read that as 5, 6, 7, 8 trillion of holdings of US treasuries. The data in orange is not my data, it's data that comes directly from the Congressional Budget Office. In other words, the overseers of fiscal prudency or in fiscal integrity in the US. The Congressional Budget Office basically uses, for the period from 22 to 25, Federal Reserve projections based on their anticipation of a QT policy, which is reducing the size of the balance sheet. Thereafter, the balance sheet expands again because Treasury holdings go up, and that is the orange line. Now, although number one, I don't believe that there'll be a QT along the lines that we can see here. In other words, I think the best path is probably a flatlining at best of those Treasury holdings. Notwithstanding that, that's a small point, but I think that the other side of the dog leg, the period of pickup from 2025 to 2033, is way too conservative, because it assumes a very low level of defense spending. If you get to a more reasonable 5% of GDP level of defense spending, then what you are seeing are the gray bars in terms of Treasury holdings. And the numbers that you see above each bar is the assumed growth rate pro rata in the Federal Reserve balance sheet each year. Bottom line is we're back to QE again, big time. In the last 2 or 3 years, the Federal Reserve has bailed out the financial system. In other words, it's tried to maintain financial stability, viz what it's doing to the regional banks. What it's likely to do in the next 10 years is to bail out the government, because what it needs to do is to preserve fiscal stability. And what we're likely to get is a period of sustained monetary inflation. And that is the worry that I foresee. Now, there could be alternatives to that. One of those is that federal spending is curtailed. The problem is that there's an awful lot of mandatory spending that's coming through for demographic reasons, which is basically set in stone. You can't do anything. The second thing is that what about raising tax rates or trying to somehow improve the tax take? That's kind of very difficult because we're in a world of international competition in taxes. And if the US raises taxes, capital may shift internationally. The other thing is that if you look at the record, tax revenues move very closely with the level of Wall Street. So if Wall Street is in the doldrums, tax revenues is going to be low anyway. Another possibility is, what about selling debt to foreigners? Well, good luck there, because China's been a big buyer at the margin. And I would guess that geopolitical factors probably weigh in and mean that China is not going to be such a big consumer of treasuries in the future. And then there's the domestic pension funds and households. Well, that's possible, but then I would guess that interest rates have to go up in order to lure buyers into the market. And if that happens, the Treasury's interest bill is going to start to skyrocket, and you're sitting on a knife edge when it comes to debt accumulation. So I don't think that's there. So the only possibility is the Federal Reserve's got to come in and basically start to buy treasuries. In other words, what it's doing is monetizing indirectly the deficit. Now, what does that mean to Joe Public, to the average investor? Does it mean you're going to get more high street inflation? Probably, not certainly. Probably is the answer. So you've got to be aware of this. We've got to start to move towards a world where you need more inflation hedges. Do you need to, or should you be buying bonds in this environment? I think unlikely. That's unlikely to be a great investment. Look back historically of when you've seen periods of monetary inflation, bonds have not done particularly well. So you're likely to see negative real interest rates, or certainly very low real interest rates. What about traditional inflation hedges, like residential real estate, like precious metals, or a new one like cryptocurrencies? I think all those boxes are ticked. I think all those look pretty good. And what we're doing is we're moving into a world now, I think, where there's likely to be more and more governmental control, because fiscal finances are getting out of control more and more. There is a need to create growth. There have to be investment programs that will have to be channeled through governments. I'm talking about the green agenda or more defense spending. And therefore, the governments are coming back at us. And therefore, we need some sort of independence, which is why gold, precious metals, and maybe crypto are ideal longer-term investments while you can.
So you're saying that for the average, totally average investor looking forward, your projection is a better place to have your money is not bonds, it's in the stock market, or it's in hedge investments like precious metals or possibly Bitcoin, rather than those safer plays.
Absolutely correct. Because bonds in an environment of monetary inflation are no longer a safe asset.
Michael, I'm loving this perspective. I want to remind the audience, links for your Twitter, CrossBorder Capital's Twitter, down below in the video description. Check it out. I want to pivot just to get your general thoughts on Bitcoin and on cryptocurrency, but just any final thoughts on macro, on liquidity.
Okay, I think let me just say in terms of further sort of points in terms of contact points. I mean, we have a website, which is crossbordercapital.com. I've written a book about this, which is called Capital Wars, which is published by Macmillan Palgrave. And we've got a Substack site, which is also entitled Capital Wars, where we go through a lot of this research. In terms of final thoughts on liquidity, I don't want to suggest that this is a downer on the US, because when you start to look at the fiscal backdrop, the US is the cleanest shirt in the laundry here. A lot of other countries are in far, far, far worse shape than America is. And that's the reality. So, I'm certainly not suggesting that among paper currencies, the dollar is going to be a weak currency. I think that the dollar as a paper unit holds its head up and is probably in a structural bull market. But vis-a-vis other instruments like gold or maybe crypto, I think the dollar is outshone by those alternatives. So I think that's point number one. I think point number two is that what you're beginning to see after some years of strong capital inflow into the US is that the margin money is starting to shift towards Asia. Now, I'm not suggesting here China necessarily, but you can see very strong evidence of money moving into some of the other Asian economies, notably Japan and notably Korea. So I think that's one of the things to start looking at as well for investors. Need to diversify portfolios. It's not all about NASDAQ. You've got to start looking worldwide. But I think in particular, Asia and let's say Western influenced Asia is a very good place to start. And Japan, you can follow the lead of Warren Buffett because he's actually gone there recently with great success.
Would you flip the screen so it's just us again?
Yeah, of course.
Awesome. Awesome perspective on macro. In general, what are your thoughts on Bitcoin?
Well, I think that let me answer that in two ways. I mean, one is what is the case for crypto? I think the case for crypto is that is a compelling one because basically crypto, in theory, has restricted supply. It is not subject to the same forces as paper money, which is government issued debt, effectively. And we know that governments or the fiscal arithmetic facing governments is horrendous. So basically, in terms of supply considerations, crypto has to be a better vehicle. There is a demand case for crypto in certain cases. Now, I would be the first to say that that may be in certain areas slim and in other areas compelling. If you look at things like the Ripple currency, which is a bridge currency, I think that has compelling attractions as a crypto unit. I think there are other crypto which I simply don't understand, and therefore I'd be the wrong person to comment. I think in terms of Bitcoin, it's established, it's first through the door, it's got a name, and it's approved effectively by the SEC as a currency. And therefore, we've got a number of issuers in the US trying to do ETFs on Bitcoin. So, hey, why not? It probably is a decent alternative.
So when you see the BlackRocks, the Citadels, the Fidelities in their own ways getting into Bitcoin, does that open you up to getting exposure in your business for your clients, or is it too early?
I think the one has to have some exposure to crypto. I think it's, as I say, it's through the door. It's an established medium. I think you've got, as I say, a varying use case, but providing supply is more constrained, which in theory, at least it should be. There's a compelling argument that these are decent stores of value, but don't just rely on those things because we've got to acknowledge the history books, and the history books show that if you go back to the 1930s, there was was it called I forget if it was called the Gold Act, but it wasn't in 1933-34 where Roosevelt basically made holding of gold illegal for US residents, and that was something that probably could not be done now. But hey, let's never say never here, and that's something I think we've got to consider. So diversification is clearly the key thing. One of the things that governments don't like doing is losing potential revenue streams.
You have decades of experience as an investor in general. So if you're just talking to crypto investors, could you give some advice to these crypto investors coming into the market in these last few years?
I think there are two things to say. One is that the most important variable to understand is are money flows, and you've got to understand how the system is working. Basically, what I specialize in is looking at asset price inflation. And asset price inflation is all about understanding money flows from a macro standpoint. Now, I'm not saying, and don't misinterpret, I'm not saying that looking at individual securities and adopting a value investing approach, a la Ben Graham, doesn't work. Clearly it works. That's a pretty good discipline. But you've also got to look at macro. And macro is all about understanding money flows and how those money flows are allocated. And effectively, this is a portfolio decision. So if that flow of money is going to increase in the future, and I would argue that money flows, because they're created by central banks and by governments at the end of the day, have to increase, okay, then we as investors have got decisions to make as to how to allocate that money. And basically what you've got, I would argue, are sort of three basic pots. You've got traditional bonds, which in an environment of high monetary inflation are not going to be decent performers, particularly if governments can't afford to let interest rates go up too much. The second thing is you've got equity markets. Now, equity markets can do well in a higher inflation environment, they will not do well in a very high inflation environment, but they'll do well in a high inflation environment. And just remember again the history books in examples of hyperinflationary economies. Think of what's happening in Zimbabwe now, right? Think of what's happening in Germany in the 1920s. The stock markets were extremely strong performers because they were inflation hedges, okay? Bonds did badly. Now, as I say, there are better alternatives to the stock market when you've got very high inflation, and that comes back to traditional monetary hedges, such as real estate, such as commodity markets, such as precious metals. And I would add probably crypto as well in that same sphere.
Michael, I want to give you a fun question, more thought-provoking question. You don't have to mention cryptocurrency at all, but say you were 25 again, starting over, and you had an extra $1,000 in your pocket. How would you go about forming a portfolio or investing that $1,000?
Well, I think the first thing to ask is, what is the time horizon? But let's assume, let's assume you take a 2-year time horizon for argument's sake. I would have probably I'm going to exclude real estate because that's that's clearly a social decision. But I say that of that, I would tend to be putting about 80% in stocks and 20% in inflation hedges. And I think the preference you can say is, do you prefer gold or precious metals, which is probably, let's say a generational decision. So basically people, like myself or maybe older people would tend to think that that is the best inflation hedge because traditionally it has been. Or you'd say, okay, for a younger cohort, you want crypto. So I'd be thinking of that 80-20 balance.
And when you say 80% in stocks, what type of stocks? Or could you give me some breakdown on what you would be looking at?
I think that if you, this is, back of the envelope, but I would say that probably, for a US investor, you'd be wanting to put you'd want to diversify 20 to 30% of that. I would tend to think that at the moment as we stand, a large part of that diversification ought to be in Asia, into countries like Korea, Japan, as alternatives. Those look attractive to my view. And if there is a coming Cold War with China, then these economies have to be bolstered anyway as a bulwark against Chinese expansion. So I think that economically they may prosper. So I would say that would be my bent in terms of geography. I think in terms of sectors, I think one has to acknowledge that technology has a place in every portfolio. And I'd also say that commodity markets probably also, because in an environment of, let's say, heightened geopolitical risk, resource availability and securing resources has clearly got to be key. And we've underinvested in this area of so much over the last 20 years that there's got to be a lot of money moving towards commodity areas. So I'd say those have got to be fairly big weightings within a portfolio.
Final question, and this is more about you, not so much about the current state of the economy, but for you, could you finish this sentence? I became successful when I understood blank.
Oh, I think the key question is understanding global liquidity. And that was something that was taught to me at, when I was at Salomon Brothers. And I think the thing to look at is, why was Salomon Brothers such a dominant and such a successful investment bank through the 80s until the mid 90s? And basically what happened, if you look at the history books, it was derailed because of errant traders trying to corner the treasury market. And Salomon was slapped down, understandably, by the US administration. But up to that point, it was a money-making machine. And it was all about understanding the flow of money around the world.
Michael, awesome perspective. Links for all your stuff down below. I want to have you back in 3-4 months and revisit some of these charts, but just final thoughts for the Altcoin Daily audience.
Good. I think my final thoughts are, I think we're in a bull market. Bull markets never go in straight lines. But in my view, global liquidity is now picking up and is likely to peak out sometime around about 2025, 2026. And that's a tailwind behind investors. And so what you want is basically to start thinking about moving towards more risky assets.